Okay, hello class. I'm sorry about the disconnection issue of last weekend, but I hope to deliver the last Sunday's lecture now on video. And the screen share is about fundamental analysis at the moment. I will review the fundamental analysis, which is how to get the earnings of the company, net profits, and then how it influences the share price moving up like that. Whatever's the net profits over here, there's a space between the net profits and the market value of the company. So that the space between the two is actually the price to earnings ratio. Um, so later on, we'll calculate it in terms of billions of market value and billions of net profit. And then we'll also calculate it in terms of price per share and pesos of earnings per share. So this is the fundamentals that we're talking about. It's the earnings of the company which pushes up the share price. And this is how do you find the strongest stocks which give you good value? You find them among the companies that give you good net profits, where their net profits are growing ideally 20% a year. So that's what you're looking for. And let me skip to page 3 or slide 3. Lesson number 1 is that if net profits of a listed company go up, then the share price also goes up. Okay, if the net profits of the listed company go up, then the share price also goes up. Okay, here's the diagram. Slide 5 na ata to. And it says that if the sales are moving up over time, then it stands to reason that the profits are also moving up over time. And then if sales is up and profits are up, most likely the share price is also moving up over time. And you can estimate this for years. Like if the past 5 years sales has been going up and also profits have been going up, then you can almost be sure that the share price continuously for maybe the next 5 years could also continually be moving up. So that's the way that stockbrokers estimate. It's possible to get a general idea that as long as sales is moving up 20% a year and profits also 20% a year, then most likely the share price could also be moving up 20% per year for the next 5 years. Kaya up to 10 years. Now this is important because long-term investors think in terms of 10 years minimum, sometimes 40 years maximum for investing in shares of stock. So why will I buy the stock? Because it's a good company. It's going to make money because of, like, Meralco makes money on electricity, and PLDT and Globe make money on telephone calls and internet. So for as long as they have lots of sales, they will have lots of profits, and that share price can continue to go up, even though there are some ups and downs from month to month, but at least over the years it's going to be generally moving up. Okay, so that's the fundamentals number 1. Here's a slide about Ayala Land pointing out that in 2013 it had 12 billion in net profits. By 2015 it had 18 billion in net profits. By 2017, 25 billion, and then that moved up to 30 billion, and unfortunately it's down for 2020, but for 2021 I'm hoping that it exhibits growth of 31 billion over the 2019 numbers. This company, Ayala Land, even if sales are depressed over 1 year, they have properties which tend to, sometimes there's no sales, sometimes there's a slackening of the real estate market, but they still own the real estate, and sometimes the transactions just stop, but the value of the real estate remains constant, and then it eventually moves up again as the economy grows, because people need places to stay, people need offices. Oh, not so much. They need factories, they need delivery, they need real estate still. Even if you work from home, well, you need to have a nice workplace at the home. So I guess houses are being designed to have an office Zoom room or online meeting room in one corner of the office. It used to be a game room or a den or recreation room. Maybe it's now online meeting room. So here's an illustration about PLDT. how it went from 10 billion pesos of profits to 18 to 22 to 38 to 43, and that's the golden era when the share price went up all the way to 3,000 pesos per share up to 2015. And after that, it suffered problems because the more they sell internet, the less people make phone calls or send text messages. They just rely on the free messaging apps. As long as you have Wi-Fi, then everything is, all the messaging and the phone calls become free. So that's actually a disadvantage for old style phone companies who sell internet and they don't make any money anymore from phone calls or messaging, but rather they must think of something like e-commerce to be able to participate in the growth of the economy as people buy more things online. I think Globe has a head start over PLDT in that regard. So there was a nice move up in PLDT share price up to 3,000 in the year 2015. So that's that's the ideal situation where you have the share price moving up over time because your profits are also gaining ground. They're not going to match one-to-one correspondence. Sometimes they move apart the price and the price earnings ratio, the price and the earnings per share. They move up and down, but generally speaking, they track each other over time as they move up. Okay, so that's how PLDT got to 3,000 pesos per share in 2015. Back to the review slide where it says that if sales is moving up over time, then normally profits also move up at the same pace or similar pace, and then cash dividends also moves up, and of course the share price also moves up over time. This is a company with good fundamentals. You're looking for a company with good strong sales and it's not threatened by competition. Ideally, it would have strong monopoly power and be able to charge high prices. Or it would be very competitive or very innovative and be able to charge premium prices than its competitors. What happens if the company has good profits? Normally they have nice cash dividends that they can give out, and that makes it into a more desirable share of stock. The higher the cash dividend, the more desirable is the share of stock, and therefore the higher is the share price. So keep on looking for companies with good, strong profit growth, also good cash dividends that they pay out, which is fairly consistent over years. And if you can find that, then most likely you can expect a higher share price over time from that company. And do this with Philippine stocks as well as overseas stocks. Here's my example of Ayala Corporation, which shows you how we'll take the price per share of 2016, which was 730 pesos per share, and then divided by the number of multiplied by the number of shares of 620 million shares gives you a market value of 453 billion pesos worth. So that's market value is 453 billion. If you put that over 26 being the net profits, then 453 over 26 equals 17 times. So market value of 453 divided by 26 billion pesos of net profit equals 17 times earnings. Market value over net profits. It's the same calculation as price per share over earnings per share. So right now with the Ayala Corp example, price per share is 730 divided by 42. The 42 comes from 26 billion divided by 620 million shares. So that's how you get 42 pesos per share. You can now get the price per share of 730 divided by 42, and the answer is also 17. And I point out over here that if the price of the stock is to go up, then it needs to encounter a higher earnings per share. In this example, the earnings per share at the end of 2016 is 42, and if it goes up to 60, then you will see a higher share price of 1044. And meanwhile, if you have EPS of 72, then you will see share price of 1253. It's 72 times 17 equals 1253. So by ratio and proportion, the higher is the EPS, then the higher is the share price by a certain multiple of 17 in this example. Bear in mind that 17 is an average number. Sometimes it's above 17, below 17, it fluctuates. Average is 17 times PE for Ayala Corp. It sometimes reaches all the way to 24 on good years. Now, similar example with Globe Telecom. At the end of 2016, the price per share was 1,509. And if you divide it by the EPS of 120, you get 13 times earnings. Now, if you use the numbers for market value, 200 billion divided by 15 billion or 15.8 billion, then the answer is the same. It's also 13 times earnings. 13 times. That 200 billion over 16 billion gives you 13. Okay, so whether you're taking the billions number or which is market value divided by net profits, or you're saying price per share divided by earnings per share, in both cases it's 13 times. Okay, so now the Globe Telecom therefore is 13 times earnings when the share price is 1509 divided by 120. But if the EPS goes up to 160, 192, 270, then that EPS can go up to 2000, 2004, 3004. What if the opposite happens and the earnings per share goes down? Then you can expect a lower share price. So it's just EPS goes up, share price goes up. If EPS goes down, share price follows all the way down. And that's how we generally forecast stocks which are industrial. Later in future sessions, I'll talk to you about price to book value, which is how you measure banks, and then price to net asset value of the land assets, which is how you measure a real estate company like Ayala Land. But for now, to make it easy, we'll just talk about price to earnings. That's for industrial companies, manufacturing companies, utility electrical companies selling electricity. Their earnings is what drives interest in the stock. If they're earning more money, then the dividends will be bigger and they will attract more interest among investors. Same story with Meralco. In the year 2016, the share price was 274, and you can divide that by earnings per share of 17.01 to get a price earnings ratio of 16. If you raise the 17.01 EPS to 19 or 21 or 23, then you can see a share price going up to 300, 332, 365. So that's what drives the share price. It's a higher EPS. And then for Meralco also, the calculation is the same. If you're using market value, look at the bottom. 309 billion pesos divided by 19 billion pesos gives you also 16. So it's the same price earnings ratio, whether you calculate in the billions or calculate in the pesos. The difference is the number of shares. Okay. PLDT, the example here is a share price of 1365 divided by 93 equals 15 times earnings. If that EPS moves up to a number like 111, 133, 160, then that PLDT share price can move up to 1,966 or maybe 2,359. Could, if its EPS goes up. What if the profits are stagnant? Then the share price will also be stagnant. What if the earnings are declining? Then the share price will just languish and also decline. So that's generally how it works with fundamentals, gauging the possible share price of the company based on its earnings power. So the same slide, I overlaid some explanations, and I say that you observe the price earnings ratio which is 15 at this point in time of the calculation, although it's not really 15 for the entire year. As the share price moves up and down, then that price earnings ratio moves up to 20 times, down to 10 times, and it makes an average of 15 times. So, uh, as a forecasting rule, if as soon as the price earnings ratio moves up to 20 times, from the average is now at 20, then you have reason to believe that from 20 it'll go back down to 15 and maybe even go past it and go down to 10, and from 10, if it goes down to 10 times earnings, then it has reason to rise up to 15 again and might go past that to 20. So it generally moves uh, from 10 to 20, averaging 15. And that's how we calculate what the share price could be next. If it's coming out of 20, then most likely it's headed lower. If it's coming out of 10, it's probably headed higher. There's a cycle in share prices and also in the price to earnings ratio. So if it's a low price earnings ratio, chances are it's a depressed moment in the life of the company or the economy or the country, and then investors are not willing to buy. But when they get investor appetite again, then that share price can move up as the price earnings ratio moves up to 15 again, and then perhaps onwards to 20. After it's been at 20 for a long while, then maybe so you can start to surmise that maybe the time is coming for another a negative wave to come through. After all these positive waves, then you could surmise that maybe it's time for a negative wave to come on. And if you're at a price earnings ratio of 20 times, which is your upper limit, then you can forecast that it's probably headed lower to 15. I don't see it moving from 20 times earnings up to 25, 30, 35. Nope. Normally, it goes back and forth between 20 and 10. So, pag nasa 20, malamang pababa na siya. Pag nasa 10, possibly, pag may good news, tataas. All the way to, well, first 15 and then to 20 times earnings. That's how the fluctuations move. And then you have to personally see what the pattern is and try to figure out this stock. I know this stock. I've been observing it for 5 years, and I think normally when it hits this level, it goes down. When it hits this level, it moves up. So similar to technical analysis, the technical analysts say when the price hits this level, stock goes up. When the price hits this level of resistance, the price goes down. So that's the technical analysis part. Ito naman would be the fundamental analysis, where you're saying price divided by EPS equals a price earnings ratio of 15, which is average. But whenever the price earnings ratio of the stock is above average, oh, that's probably headed lower. If it's below average, well, I'm expecting and hoping that it heads higher. So that's how we use this. Okay, here's another illustration on this page. As the price goes up or down, the price to earnings ratio also fluctuates. And it fluctuates from 15 down to 10, up to 20, down to 10 again, up to 20. And maybe it goes down to 15, just 15, and then starts moving up again. So we really have no way of knowing what the price will do, but it makes sense to understand that there's a range, there's a high, there's a low, and there's an average. So you simply try to use your best judgment to check whether I think that stock is headed lower, or I think it's headed higher, or I think it's headed sideways. So this is what investment analysts debate about after hours. So here's an example of pure gold's price earnings ratio, where there's a thick black line which is called the average, and then some dotted lines above it called average plus 1 standard deviation, and then another dotted line, average plus 2 standard deviations. Now the observations around the mean plus 1 standard deviation, this is the majority of cases. The mean plus 2 standard deviations, that's 95% of all the cases. But mean plus or minus 1 standard dev, that's already 68% of all the observations. You might say it's majority. The way you use this is that if you have a stock where the price earnings ratio is way below average, what's the meaning of way below? 2 standard deviations away. If it's 1 standard dev below the mean, it's just below average. If it's way below, it's probably 2 standard deviations below the mean. And it's not probably going to go any lower, but probably going to recover and move higher if it's 2 standard deviations below the mean. The same thing with if here's the mean and the price earnings ratio of the stock is above, then most of the time it goes back to the mean rather than extending outwards. If it does, then it's unlikely that it remains there. But the moment it reaches 2 standard dev above the mean, it's already overstretched, or shall we say overpriced, and you might be able to justify sell, because I think the share price will be moving down back to average and maybe going beyond below average. So that's how you read the price earnings ratio cycles. It's also sometimes referred to as the bands of price earnings ratio, meaning from here to here is 18 to 20, 20 to 22, 22 to 24, like price earnings ratio bands, like a bandwidth. And if you are in the upper bands, then you are likely to come down. If you're in the lower bands, you're likely to move up eventually as soon as there's some catalyst that will make the price start moving. Okay, so you observe that the price earnings ratio moves up and down the average of 19. There. So that's your knowledge and understanding of that stock. And then you're, like any analyst, you don't know what the future will bring. But if your goal is at the mean, then it's hard to tell whether it's headed up or headed down. If it's 2 standard dev above the mean, you can forecast that it's headed down. If it's 2 standard dev below the mean, you can forecast with confidence that it's headed upwards. Okay, so here you go. Anytime the price earnings ratio is at 20 times, you may forecast that it will likely go back to 15 or the mean. What's so special about 20 times or 10 times? That's the upper and the lower limit. And then it could also be the upper limit, meaning majority of the observations are found between the upper and the lower limit. That seems to imply that's mean plus one and minus 1 standard deviation. So that captures about 68%, majority of the cases. And same interpretation. If you find the stock where the share price is at a high price earnings ratio, definition of high is that it's mean plus 1 standard deviation above the mean, then it's high. It's high PE, and you may forecast that it should go back down to the mean. And if it's 1 standard dev below the mean, then most likely it should go back upwards to the mean. Of course, it's still tricky to say when. And actually, nobody knows when. But the interviewer on TV keeps asking, when will it go up? And actually, nobody knows. So an honest answer is to say, I have no idea. But we're looking forward to possible news that might break out, that might push the stock upwards. There's news happening next week, economic data. There's a political event happening in 2 weeks' time, and there's a social event happening in 3 weeks' time. So you're telling the clients that if these economic, business, political, or social events are positive for the stock, then we might see the price moving up as those data bits emerge, the economic data, the social, the political data. Those are the catalysts that will make the price eventually move up. If you were expecting it to move up, you just don't know when. All right. There. So, well, here's again the illustration of Pure Gold's price earnings ratio. And okay, I left that now. I'm showing you PLDT TEL declining earnings per share. There was a span of 5 years when PLDT profits went from 33 billion down to 22 billion down to 13 billion because they were selling more internet, and because of that, people were not anymore making phone calls and not anymore sending text messages, but rather using free messaging apps and using free Skype calls. So from 2013 14 all the way down to 18, PLDT share price started to decline. And that's because of the declining EPS and causing the declining share price. Try to understand that they're really related, the earnings and the share price. Now, Globe Telecom in the same 5-year period went from 5 billion of net profits to 16 and 15 billion. So therefore, 5, 16, 15. Causing a shoot up of the share price and then a plateauing. As the profits went from 5 to 16 and then down to 15, so talagang tumaas muna yung share price and then nag-plateau. Okay, so here's Globe Telecom's data from 4.9 billion to 13 to 16 to 15.8 to 15.07. So these numbers show the earnings per share, the net profits moving from 5 billion to 15 billion. Jollibee had a good 5 years from 2013, 15, 17. Net profits went from 4.6 to 4.9 to 7.1 billion. So generally upwards. And I'm hoping that they report positive profits by next year. Hoping, no? And if that's the case, then Jollibee share price could again challenge the all-time high of 330 and might even go to 400 plus. Certainly it was down in year 2019 to 20, maybe up to 2021, but it might go high again in the future depending on consumer behavior. This is just the data of Jollibee moving its profits from 4 billion to 7 billion. There. So, funny that the data is the 2013 data is on the right of the page and the 2017 data is on the left of the page so that you'll see it first. But personally, I would prefer that it goes in time, 2013 to the right, 2017. So I often have to restate this raw data so that the years are marching from left to right. Here's an example of SMC Food and Beverage from 4 billion of net profits to 4.5 and upwards to 6.6. That's a good trend. And upwards to 9 billion in 2019 and hoping for 13 billion in 2021. Hoping. And if those hopes pan out, then you could see that share price moving way above 100 pesos per share. It could be high in the future. It's selling hot dogs and beer, the Pure Foods and the brewery. Okay, you can press pause if you like and then resume playing the video later, or okay, you can continue. Now I go back to revisit the example of the EPS of 5 pesos moving up to 7, and then I illustrate how that helps you to forecast the share prices. So let's take a sample company where year 1 the net profit is 50 billion and then the number of shares is 10 billion. So therefore 50 billion divided by 10 billion is 5 pesos per share. And the following year, year 2, which is next year, you're forecasting that it would reach 70 billion. Number of shares remains the same at 10 billion. So 70 divided by 10 gives you 7 pesos per share. At least it's moving up. So if there's an EPS of 5 pesos moving up to EPS of 7 pesos, that's good progress. The earnings per share is moving up. Earnings per share in pesos is moving up. So if this year it's 50 share price divided by 5, 50 divided by 5 equals 10, multiplied by 7 of the earnings per share for next year, then you might have 70 share price next year. Right, so based on a price earnings ratio that's average of 10 times, or at least today it's 10 times, but I know that it fluctuates between 15 and 5, so and the average is 10. If the earnings per share for year 2 is not going to be 7 but rather 10, then 10 times 10 would be 100. That would be your price target for this good stock with rising EPS. If Ayala Corporation had 750 pesos back in 2016 and the EPS was 31, then 750 divided by 31 will give you a price earnings ratio of 24. If, however, the earnings per share is going to be 35 by 2017, 35 times 24 should give you 840. And I think Ayala Corporation stock reached that price. And if you look at the earnings the following year, it will give you an EPS of 40. And so the share price was well justified to move up to 960. 960 divided by 40 is still 24. Sorry, 24. And what happens if the 2019 EPS is going to be 46? Then you say 46 times 24 equals 1104. That would be the price target in 2019. Of course, we're looking at the past to see how things panned out. Okay, press pause if you like. If not, you can continue. The next lesson is about how some stocks have higher price earnings ratio than others. You can compare that with fuel, which has premium versus regular. Or for that matter, you can compare it with airline seats, which are ranging from first class or business class to premium economy down to regular economy. And the quality of the fuel affects the price. So for example, between premium and regular, there's usually a price difference. But let me ask you a trick question. There's a gasoline A which is 100 pesos for 2 liters, and it's competing with gasoline B, which is 50 pesos per liter. Which one is more expensive? So it's a trick question. Right? So no, it's not the 100 nor the 50. They're the same. They're the same. Now, what about these two cans of fuel? One of them has a liter of fuel selling for 45 pesos, for example. And then the big can sells the same fuel at 200 pesos divided by 5 liters. So it looks like 200 divided by 5 would be 40 pesos per liter. It looks cheaper than the 45 per liter. Cheaper by the bulk. So probably has to do with the packaging, which costs money, maybe. And similarly, when you encounter somebody buying shampoo, he's thinking or she's thinking, should I buy shampoo 5 pesos per sachet or get the big bottle 200 pesos divided by 50 ounces? 200 divided by 50 should be 4 pesos per ounce. That should be cheaper than the 5 pesos per ounce. Because packaging, in the case of the sachet, costs more money than the big bottle of shampoo. Okay? So the shampoo sachet costs 5 pesos per ounce, but the shampoo bottle will cost only 4 pesos per ounce because it's 200 divided by 50. Okay. You can take a break now. Or you can continue. So this is lesson number 3. I'm not sure if it's 3 or 4. So share price over EPS equals price earnings ratio. And it's quite unique for every stock. Each stock has a unique average price earnings ratio year after year. It's similar to a person's body temperature. And I would encourage you to learn what's the average price earnings ratio per stock and to master it so that you can tell when a stock is overpriced or underpriced. Now, when it comes to price earnings ratio, some stocks are just okay, nothing special. They are trading at 12 times price earnings ratio, maybe even 8 or 9 times or 10. They're just okay, nothing special. The moment you go to 20 times earnings, then you're talking about exciting companies with good profits and big opportunities ahead of them. They make their own destiny. They're big enough that they can buy competitors and sales outlets and providers, suppliers. Scusi. So then, These are line of 20. These are Ayala Corp, Ayala Land, Banco de Oro, Globetel. At one point in time, they had a price earnings ratio around 20. Why is that? Because they're more exciting companies, they're facing bigger opportunities. And then there are some companies that are very exciting, they have lots of fans from around the world, and they have good profit and strong potential. So that would be like Jollibee and SM Prime. At one point, they were price earnings ratio of 35. That's high. So now, uh, we're looking for, again, this page is looking for fundamentals where we want the earnings per share to be constantly moving up over time so that the price per share would be totally justified and also moving up over time. Okay, so to get earnings per share, you simply divide net profits by the number of shares. Okay, next lesson is lesson 4. High price normally corresponds to high quality, and the low price is normally awarded for goods of lower quality. Now, what's the meaning of fair price? Is this car worth 3 million, the one above? Maybe. The car below, it's probably not worth 3 million. Alright, so when it comes to the Toyota Vios, it has variants that are priced from 620,000 to 1 million pesos. Okay, so if you're talking about Mercedes-Benzes, then 3 million is cheap for a Benz. Now, there are levels and classes of cars. For example, you have a taxi, Vios, used for Grab or Uber, and that normally would cost 620 to 1 million per car. If it's a sedan that you want, then you would pay 1 to 2 million pesos per sedan. And if you want a sport utility vehicle, it could cost you 4 or 5 million. Okay, so depending on the quality of the company, prices tend to be higher for high quality companies than the low quality companies. Okay, now what about forecasting share prices by studying the ups and downs of the waves of the share prices? Good plan. Look for the pattern, find the pattern, extend it into the future, and then check if the forecast makes sense. So here's an example of, this diagram is about if earnings per share move up, then share price normally also moves up. And I say next year, but it could also happen within the same year as the letter writing from the messaging from the stockbrokers to the clients. Stockbrokers used to write market letters, but now they publish them on the internet, of course. They write letters to their clients. I'll show you again this diagram, which points out that there's a cycle of low to high price and low again in share prices. And so you can measure the range of the upward movement, and you can see that sometimes it's high at this level, low again, high again, low again. And you can study that pattern and be able to forecast it for the next 5 years. Okay, so that's the point here. So at moments during the year that the price earnings ratio is high, and the price is high, then the price earnings ratio is high. If the price is low, and then the price earnings ratio is also low. And I would liken it again to low tide and high tide on a beach. If you're at high tide, then you have water coming up to the level of the high level of the beach, and then the tide would recede, and you have low tide. Then you go back to high tide. So when's the best time to buy stocks? When it's low tide. And when's the best time to sell? If it's high tide. Okay, here's the example I used in the previous Sunday, where you have one company that is experiencing good growth in the earnings per share. It's 1 peso in year 1, 2 pesos in year 2, 3 pesos in year 3. That's considerable growth, 100% and then 50%. And you have a client who bought the stock at 10 in January, and it's now Feb, and it's trading at 15. So the client is asking, should I sell at 15 or should I wait for this stock to go higher? And there were other people who were not able to buy at 10 and they want to buy the stock at 15. They're also wondering, is it worth buying the stock at 15? May itataas pa ba yan? Can it still move up a little higher? Okay, so let's check what the range of price could be for this company. We know the lowest price of the year is 10 and the highest price of the year is 15. So now we know the high and the low price earnings ratio. To get the price earnings ratio high, you get the highest price of 15 divided by the EPS of 1, you get 15. And the low price earnings ratio would be 10 divided by 1. 10 divided by 1, and that gives you a PE of 10. So you know that it's 15 or 10. And for the year 2, simply multiply 15 times 2 equals 30. 10 times 2 equals 20. That's your low price forecast for the year. And then 3 times 15 is 45 for year 3. And 10 times 3 is 30 for year 3. Okay, so it looks like this. If you bought the stock at the price of 15, then you could still double your money to 30 in the following year, or even triple it to 45 in the second year, shall we say, from year 1 to year 3. And if it doesn't work out that you triple your investment, you can at least double your investment over 2 years if 15 goes to 30. And you might tell yourself, the moment this goes to 30, I'm going to sell. Why? Because you're afraid that from 30 it might go back down to 15. Alright, so it proves that it's okay to buy at 15 and wait for 2 years. It also proves that it's very, very worthwhile if you bought it at 10, not to sell at 15 and wait until it reaches 20 or 30. Okay, so that's our forecast as an analyst. Okay. And in this diagram, I show how Ayala Corporation has a share price on the left. Share price on the left, and then my extension green line on the right. And this is how I calculated it. I typed in the earnings per share up to 2019, and then I typed in the high and the low prices per year. Divide by the EPS gives you the high and low price earnings ratio. And then you can extend that into time so that you can get possible high and low PE for 2022, and also EPS divided by also the price divided by the EPS to get the price earnings ratio. Okay, and then the EPS needs to be estimated all the way from 2013 to 19 and then extending to 20, 21, 22. Get the average of the growth rate, apply that average growth rate to the 2019 and the 2020 numbers, and then you'll see how the share price is growing steady because the EPS is growing steady, following its average growth rate. Here is an example of SM investments also moving up over time because you have the ups and downs of the share price, which you capture by typing in the high and the low prices of the year, and then divided by the EPS for that year gives you the high PER moment and the low PER moment. Okay. review. What is price to earnings ratio? Definition one is price earnings ratio to this year versus price earnings ratio to next year. Okay, this is a review so that you recall it more vividly in your mind. What's price earnings ratio to this year? It's price today divided by EPS of this year. And for the following year, it's EPS of next year below the price of today. Okay, this is called price of the stock today over the earnings per share. That's price to earnings ratio to this year. And you can also diagram it like this: price today over earnings in year one. Although you can still use the price today over the earnings of year two. You could. It's called forward is slightly different. It's similar to the forward. Here's a refresher on the lesson as to how else the price earnings ratio can be computed. It can be computed as price today over EPS for the last 12 months trailing or the next 12 months. That's what you call forward. Now the forward 12 months is the best measure. Okay, so definition of terms. Price earnings ratio to trailing 12 months. It's the price today over the earnings per share of the past 12 months. The benefit of that is that you have audited financial statements and you have reliable data. But the disadvantage of using the trailing earnings is that it might not reflect the activity of the company in the future. Maybe they changed the goods that they're selling. So it's better to invest on the basis of what might happen in the future. So we're looking at the price over forward 12 months EPS. Now, trailing versus forward PER. Again, this is trailing. This illustration is trailing. Price today over the past 12 months. Meanwhile, if it's price today over the next 12 months, it's the forward 12 months EPS. Forward 12 months price earnings ratio. Lesson 7, forward 12 months is the best measure even for the entire stock market. The Philippines used to be in the range of 14 to 18 times. Now it's in the range of 16 to 21 times. I'm sorry, this is an outdated chart. Skip that. Skip that too. I'll get you a fresher one. Wow. Okay. So here's a calculation of the index points can be divided by the net profits in billions of all the listed companies, and then if you say 8,300 divided by 415, it's equal to 20. That's the price earnings ratio at the time. Put it another way. Let's say that the index is at 8,300 points, and then you're trying to figure out what's the net profits, what's the EPS of the entire market. Then what you do is 8,300 divided by 20. 20 is given to you by the broker as the price earnings ratio on that day. So just divide 8,300 by 20. You should get 415. I hope it does. And then that 415 becomes the earnings per share of the entire composite index. Okay, skip this. So here's an example again of high PER could mean premium gasoline, mid PER could mean regular gasoline, and low PER could mean diesel. So some companies are like diesel, some are like regular gasoline, and some are like premium gasoline. Expensive versus cheap also applies to entire markets. Sometimes if the US stock market is over 22 times PE, then you can say that they're expensive, their share prices are bound to come down eventually. Those which have low price earnings ratio, Uh, Unfortunately, there might be something keeping them there, some perceived negative item in their future. Okay. So normally countries, just like companies with strong growth, get the high price earnings ratio. High meaning 20 and above. Those with medium growth get a medium price earnings ratio around 15, and those which are slow and steady get a low price earnings ratio about 10 or 11. Similar grading system or pricing system with high quality cars. Now we want to predict the share price for next year or the next few years using earnings per share and the price earnings ratio. So this might need some math skills and multiplication. Easy enough. Let's figure out the price of a can of fuel just to take a simple example. What's the price of a can of fuel? It's the number of liters times the price per liter. You can make a pinpoint forecast whereby the price per liter is 45 today times 2 liters I want to buy, then 45 times 2 should be 90. Now, what if the price per liter is ranging from 46 to 42? Okay, if you buy 2 at 46, that will be 92 pesos. If you buy 2 at 42, then you'll be needing to pay 84 pesos. Okay. So here in this example is that there's a price per liter of 45 and you're buying 2 liters. So the can of fuel should cost you 90. In this example again, the price of the share of stock times the estimated earnings per share should give you the share price. So if it's PE ratio of 45 times, typo error. And then the estimated EPS is 2. 45 times 2 should give you 90. Okay. Here's where you get the data on EPS and price earnings ratio. You get it from broker website. You can export to a file. Okay, and then this is just like learning statistics for any sport and learning how to project the statistics to be able to forecast the future. And these statistics, you have to be good at it to be able to predict which stock is on the way up or way down. There's a lot of calculations and also a lot of intuition and feel. Okay, I'm gonna skip this part. Wait a second. Okay, I think I've done the fair price already. Yeah. Okay, we're done there. We're done already. We're done with the valuation review. Okay, thank you. So done with valuation review. I'll make another lecture about the Excel file.